start the recording and then we can get started with today's lesson. So in today's lesson, we're continuing on in revenue. So if you remember very carefully, when it comes to revenue, we are still sitting here in section 3 or objective 3. So we've done objective 1 where we've discussed some definitions. We will be adding to those definitions even today and even on Thursday. We will be adding to those definitions, but the bulk of the definitions have been done. The important ones have been done. And then we discussed very briefly in lesson 1 the difference between revenue and income. And then in lesson 5, so this is not supposed to be stuck out. In lesson 5, we're just going to touch a little bit on presentation. Sorry, when I say lesson 5, I mean the lesson on Friday. So that's lesson 6 at least. So in lesson 6, we're going to be touching on presentation a little bit in class, and then that will be the end of revenue. So like I was emphasizing with you guys previously, with revenue, the key principle, the thing that's very important is that we get the discussion, we understand the discussions and the reasoning why we're doing something. And then we're going to add color to that by doing the calculations. So the calculations, you will see calculations in your tutorials, you will see calculations in your past tests. But the idea is that if you understand the theory or the why question, you're gonna get the numbers very easily, right? So that's what we want to focus on in our lectures today. I just want to do a quick recap on step 2. So if you remember what we did on Friday. In step 2, basically, if we had to encapsulate Friday's lesson in one word, we would say distinct, right? Because on Friday, when we are talking about the performance obligation, or we even said sometimes we can more easily understand it by saying the promises that we make to our customers, right? So performance obligations are the promises that we make to our customers. So when we are talking about performance obligations, we said we can only allocate revenue to performance obligations that are distinct. Okay, so when we are looking at distinctness, we need to start looking, and we looked at the standard and we saw that in the standard there were 2 criteria that related to distinctness, right? So the idea is we identify the distinct promises or the distinct obligations, and then we allocate revenue to them. The allocation of revenue we're going to do today. So the assigning of the specific revenue to specific promises or obligations we're doing today, but here we were trying to identify where are these distinct promises, right? And so in the discussion of distinctness, we found that there were 2 criteria. The first criteria was that we must be able to gain benefit, and we said that when we're gaining that economic benefit from it, the principles that we need to apply is that the resource is readily available. So the promise, the goods and services are readily available. And then we also says it needs to be sold separately, and we can't sort of look at a situation in an oligopoly or a monopoly. There must be a sort of free market in order for us to gain this benefit. So those are sort of the principles that we looked at when we spoke about the first criterion. Then we moved on to the second criterion, and remember what we said in the lecture is we said that the first criterion is very broad and very focused on the actual good and service, the actual promise, right? And so we said that that first criteria can be met easily, is easier to meet, right? And then we said now we need to start pulling in and getting more specific to our situation, and we do that with the second criterion, where the second one talks about, is this promise identifiable in the very contract that we are dealing with. So now it brings us right down to our real life situation, right? So we're looking for separately identifiable promises in the contract that we're dealing with. And remember, we said that there were sort of three things that we looked for, right? Three, what's the word? Three, not criteria, three principles that we need to apply, right? So, and the three principles were, the first is integratedness, right? And remember in class, I was getting confused with that word integrated and interdependent, right? So just remember, integratedness is where the output of one process or one promise is the input of the next promise, right? So it's integrated. It's one is dependent on the other one. Therefore, it's one promise and not many promises, right? So that was the first one. Then we spoke about something that's highly modified or highly customized, such that we can't sell it to anyone else. We can only sell it to that one customer. And if that is the case, then we do have only one promise and not many promises. And then the last one was interdependentness. And remember, we spoke about interdependentness. We gave that example of the toothbrush. And we said the toothbrush can function as a brush independently, but it doesn't provide you with a clean mouth, right? If you just use it randomly on random household objects, right? You have to use it only on your teeth in order for it to provide cleaning, the effective cleaning of the mouth. So with interdependentness or interrelatedness, we see that the promise itself does exist and function on its own. It exists and functions on its own, but it doesn't meet the requirements of the contract. And that's why we were talking about in the second criterion, we were talking about it must be in the context of our contract. And so that's where that question gets asked, does it meet the purpose of the contract? And so those are the two criterion that we spoke about when we did distinctness. We also just briefly touched on implied performance obligations. Remember, we said explicit is easy because explicit we're going to find it in the contract, right? That's an easy one to spot because you're just going to read the contract and you're going to find the POs in the contract for explicit. But implicit, the one with I, implicit POs are a bit more difficult. And so what do? We look at customary business practices. So what's happening in the industry, what's happening with this specific entity in the past, and then we look at what are the expectations of the customer, and are those expectations reasonable? Do they expect that the entity is going to satisfy those expectations? So those are when we're dealing with implied POs, that's what we need to look for, right? And then so that was how do we determine if something is distinct. Then the other question that we had was, okay, cool. So now we've decided this is distinct and maybe this other PO is not distinct. What do we do with the PO that's not distinct? Because the one that's distinct is okay, we'll assign revenue and move down the steps with it. But the one that isn't distinct, how do we go past step 2? Right? And then we said the only way that we can do that is by bundling the goods, right? By creating series of goods and services. Bundling them means putting them together, right? And if you remember we did an example on Friday. We did an example of the equipment and the installation of the equipment, and we said we have to bundle the installation together with the equipment because individually they weren't distinct, right? And so we had to bundle them together. You see, so we had to bundle them together until such time that they became distinct. And when they were distinct, then we're able to move down the process and start allocating transaction price and whatnot. Okay, so in today's lecture, what we're going to be doing, so first, for the first part of the lecture, we're going to be focusing on step 3, right? And step 3 is where we are trying to identify the transaction price, right? And it's not going to be as simple as we think it is. There is a little bit of work to identify the transaction price, but we're going to get into it. We're going to be covering quite a lot of ground. However, not everything that the textbook covers is important. So the textbook goes very much in depth, and I will just pinpoint areas that we need to look at and areas that are important for our purposes, and then you'll know what to focus on when you reading and studying your textbook. Okay. So today we want to do determining the transaction price. Now, the important thing is, and remember we said our key principle, our theme, basically text for this series of lectures is we want to ensure that we record revenue that reflects the economic substance over the legal format, right? We said we want to make sure that our revenue reflects, or the revenue that we record reflects the what exactly we think is going to happen, and that's why we said we use those words expect. We want to record what the entity expects to be entitled to, right? So the revenue that the entity expects, and that's why we're saying we hope to record what we really think will happen, as opposed to what the lawyers are telling us will happen in the contract. So that's what we're aiming for. That's our theme text. That's the thing that we must always refer back to if we get confused. We need to ask ourselves, what best reflects what we think is going to happen in this situation, what best reflects it, and then we that should guide us in our decision making. Okay. Now let's just start off a little bit with discussing a transaction price, right? So the transaction price is basically, so it's not the same as the contract price, right? That's the first thing. Remember, we spoke about contract price. So this morning, someone was asking me about the contract price. We spoke about the contract price back in lecture 1 last week, Thursday, right? And so what we said is that the contract price is the amount that we read in the contract. That is the contract price, right? And the contract price is not always the same as the transaction price. And remember, we said contract price is for lawyers, transaction price is for the accountants, right? So now the question is, how would we define the transaction price, right? So the transaction price, not the same as the contract price, is the amount of money, right, that the entity thinks it will get when it transfers or exchanges the goods and services that it has. Right? So that's the first part. We need to, and if you think of this word expects, there's something that comes to mind. When you expect something, you're talking about the future, right? You're talking about something in the future. You don't really know. We don't know for sure, but you think this is what I think is going to. You're expecting, you're predicting into the future. So that's the first element that we're going to be discussing today. How do we do this prediction? How do we predict into the future, right? Then, so the transfer of goods and services, that we're not going to talk about too much. But then the thing that we want to follow up on is the consideration. Okay, want to start talking about the consideration. So the amount of the consideration, there's going to be times today when we're going to be talking about money or consideration that is what we call variable, right? It can change based on things that are happening in its environment, right? So that's the second sort of important thing. And then just briefly in the last section of this description, we say we must leave out third party amounts. Now, what does that mean? That means we've collected money and it's not our money. We are going to give it to someone else, to a third party. And it makes sense for us to exclude third party amounts. Why? Because it's not our money, right? We've collected it on behalf of someone, right? It's not for us to keep. Okay, And so that's why we exclude that third-party amounts. And so when we talk about third-party amounts, what comes to mind is consignment stock, right? So write that down. Consignment stock or consignment inventory. Consignment inventory is inventory that we have on hand, that we are keeping on hand, but that will be used, right, by but that is owned by someone else. And so when we sell their stock for them, right, when we sell their stock on behalf of them, we need to give them their money, right? So this idea of the transaction price is something that we only look at with existing contracts. So the idea is that the contract must have passed what step? Step 1 or 2? Write it out in the chat for me. When we say we look only at existing contracts, which step does that call into question? It calls into question a specific step. Is it 1 or 2? Write your answer in the chat for me. Sure. It seems like I've stunned you. There we go. Yeah. So it's step 1, yes. So it calls into question step 1 because in step 1 was the step where we started talking about is there a contract? Can we see the meet step 1? Now, if we go back quickly, just very briefly, we're just going to go back to step 1 here, and I just want to show you this slide. I'm just waiting for it to load. So if you have a look at, so it's loaded on my side. I don't know if you guys can see it on your side, but if you have a look at this slide, so this is a slide from Thursday's lecture, and basically it's asking the question, is it probable that we are going to get paid, right? Is it probable that we're going to get money out of this contract? And so in the determination, right, of the contract, we've already looked at something called recoverability of the amount, right? Or collectability. Can we collect it, right? So can we collect this amount? We've already asked that question. So when we come to transaction price, we're not going to ask that question again. Okay, we're not going to ask the question, can we collect this amount again? Because we've already asked it in step 1, right? Which means what? It means that if we, at the beginning of a believed that we were going to get paid, let's say 100,000 rand. So we believed that the customer is going to pay us 100,000 rand, right? We've done step 1. We've done the test. We've said yes, there is a contract. Yes, we think we're going to get paid, and we think we're going to get paid 100,000 rand. The transaction price then is set at 100,000 rand. But then a couple of months later, the customer that we were working with, the customer that we had the contract with, is now bankrupt, right? And the customer can't pay us the 100,000 rand. Instead, the customer pays us 60,000 rand. What does that mean? That means that because we've already done the test for revenue, we've done the test for recoverability for revenue, and we're happy with it at the start of the contract. We're happy that we can collect the money. We don't need to restate the revenue after it has been recognized. So if we recognized 100,000 rand, we will leave it there, right? We're going to leave it there. Instead, this change in situation, right, this change where the customer is no more able to pay us, is going to be recorded, is going to be reflected in the debtor. So the debtor will have what we call a debtor's write down, a bad debts. You see what I'm saying? So there at the beginning, we thought that we were going to collect it, but later on it turns out that we weren't able to collect it. That change in situation gets pushed into bad debts, right? Everyone understand me so far? Just give me a thumbs up if you understand so far what we spoke about, right? So we don't restate the revenue. Yes, credit losses. We don't restate the revenue, right? In scenario one, because at the beginning of the contract we thought we were going to get paid, right? When we did step one, we thought we were going to get paid, right? So we don't need to restate the contract. Now, so that's scenario one. Now park scenario one in your mind, leave it one side. Let's talk about scenario two. Scenario two, when we started the contract, we knew that we weren't going to get paid the full 100,000 rand. In scenario two, we thought to ourselves, you know what? I think I'm only going to get 80,000 rand, right? So then it comes back to this question here in this definition of transaction price. Let's have a look at it. It says the amount of the consideration that the entity expects to be entitled to. And when are we doing this test? We're doing this test for existing contracts when the contract is initiated, at the inception of the contract, right? So we're doing it at the beginning. And if at the beginning of the contract, okay, if at the beginning of the contract, we thought that we weren't going to get paid the full 100,000 rand, therefore the transaction price going forward is not 100,000 rand. It is now going to be, let's say we're only getting price, because at the beginning of the contract we never expected to get paid the full amount, right? So in that situation, because we knew when we entered into the contract that we're not going to get the full amount, we would only recognize revenue of 80,000 rand, not 100,000. Does that make sense? Does everyone understand the difference? The difference comes about in when we realized that we're not getting paid the full amount. If we realized we're not getting paid the full amount only after step 1 and 2 and 3 had happened, right? And maybe we were into step 5 when we realized we weren't getting paid the full amount, right? If that is the case, then it's a credit loss, right? Yeah, I'm explaining it again. So I said if we realized that we weren't going to get paid only after we passed step 1, so maybe we were doing step 5, right? Because remember, step 1, 2, 3, and 4 tend to happen very quickly. They happen almost instantaneously, right? In terms of in a real business, it happens very quickly. But step 5 can sometimes drag and take a bit longer. So let's say we were busy with, we did step 1, 2, 3, 4, and then we're busy with step 5, and then we realize we're not going to get paid, right? In that case, we have a situation where we have a credit loss, right? But if at the beginning of the contract, we knew we weren't going to get paid, on day 1, when we started step 1, we knew we weren't going to get paid, right? Then the actual transaction price needs to change, because step 1, we knew we weren't going to get paid. So the transaction price is then lower. And in fact, what we've given that person is, because we still went through with the contract, knowing that we weren't getting the full amount, we've given them a sort of price reduction. We've given them a transaction price reduction. Someone had the hand up. Someone had the hand up. Hand has gone down. Okay, if you want to ask a question, then you can just put up your hand, or you can type it out in the chat. Okay. Okay, cool. So that's the important bit. I think the takeaway from that discussion is that, number one, once we've done the test in step 1 for collectability, we don't do it again in step 3, right? We only, and if there's a change and something that we need to worry about, then it goes into credit losses. But if we did the test for collectability in step 1 and we realized the entire amount was not collectible, right? The entire amount, we couldn't collect the entire amount, and we still went through with the contract, then the actual transaction price has to change and has to be decreased. Okay, so that's the sort of discussion that we need to have. Okay, so let's have a look at what we're going to do. So in your textbooks, you're going to see we've got variable consideration. That one we're going to do. Today we're going to do non-cash consideration. The parts that we're not doing and that are outside of the scope of back to 100 are going to be significant financing operations, as well as the amounts that are payable to the customer. Right? So we're not doing those ones. We're only doing variable consideration and cash consideration today. So someone said, so we ignore criteria 1, step 5, if they don't pay us the full amount. Don't understand what we're saying there. We ignore criteria 1, step 5. We haven't done step 5 yet. Step 5 is being done on Thursday. Today we're doing step 3 and 4. So we ignore criteria. I think you mean we ignore step 1, criteria 5, if they don't pay us the full amount. Well, we haven't ignored it. We've gone past step 1. We've identified it. We know that they're going to pay us. And at the time that we assessed it, we were happy that they were going to pay us the full amount. Right? That we were happy with. Right? So we haven't ignored it at all. We've in fact satisfied it. It's been satisfied, and so we've moved on with life. Yeah. Okay. Now, so the first sort of topic that we want to talk about. Notice how this word has changed from transaction price. We now start calling it variable consideration, because the variable consideration can be a part of the transaction price, right? It may not be the entire transaction price. It can be a part of the transaction price. We can have sort of a fixed consideration, a consideration that doesn't change in amount, and then the variable consideration, which is, remember, the word consideration is another word for value, for money, for someone is giving us some sort of economic benefit, right? So let's just replace that with value, the word consideration with value. And so we're saying there's a variable value. The value is variable of the amount that we're getting. And it doesn't need to be the entire transaction price. It can only be a part. Now, if you think of this definition of variable consideration, so variable consideration is the consideration that the entity expects to receive, right? And that amount that they expect to receive, the consideration that they expect to receive, varies based on its environment, right? So that's basically what a variable consideration is, okay? And so it's a very broad definition. And what you're going to see is that in the real world, there are many different things that give rise to a variable consideration. So we talk about bonuses and refunds and incentive plans, and we've got, loyalty rewards cards and all of these different sort of things that can result in a variable consideration. But for our purposes in Back to 100, the stuff that we want to focus on is we want to focus on refunds. We're going to do a little bit on volume, rebates, and then discounts are also going to be the big thing that we're going to do. The others are not important. They're just not as popular in Back to 100, mainly because they are a bit more complicated, and so we leave that for sort of to be done in third year, right? So those are the main causes, the main results of variable considerations that we're going to be looking at in today's lecture. Now, when we're deciding on a variable consideration, right? Now, I want to let's just start talking about it, and then we'll do a few examples, right? So a variable consideration is where the amount changes, right, based on its circumstance. So that means that it's outside the control of the entity that we're looking at. When we say the amount changes based on the environment or the circumstance or something that happens, that thing that is happening needs to be outside the control of our entity, right? And so that's the important part. It's not where it's not like us setting a price. Because if it's just us setting a price, then it's not variable. It's fixed because we know what price we're going to set. Right? Remember, we need to go back to transaction price. It says the transaction price is the amount we expect. So if we already know what amount we're going to get, if we already know what amount we expect, then it's not variable. Variable needs to be, there must be something outside of this arrangement that is affecting the price. For example, we might have a situation where we say to the customer, we say, customer, if you buy 10,000 units, right? If you buy 10,000 of our product, right? Whatever product we have, if you buy 10,000, then I'm going to give you some money back, right? And so the customer, whether or not the customer buys that 10,000 units is not in our control. The customer decides whether he wants the units or not. We can't force him, right? And so as a result, in that situation, we have something where it's outside our control. We can't affect it, right? Materially, we can't affect it materially, and that is the idea uh, um, behind a variable consideration. Now, as I was saying, because of that word expect, what we expect we're going to get, that gives us the thought that we're looking at something in the future, and that means we're estimating, we're giving it our best bet, right? We're looking into the future and we're finding what do we really think is going to happen, right? And so we talk. So your textbook goes into detail in section 7.2.3 and 7.2.4. It goes into detail about how do we come up with this expected value, right? How do we estimate this value? So we're not going to go as in depth into it as your textbook has. I think the most important thing is that we want to get an amount which is the most likely amount that we're going to get out, right? So what is the most reasonable amount that we're going to get? And so that's sort of the idea. That's the maximum of what you need to know for this um, for this part of the lecture, right? And then the next question I want to ask is, and for those auditing students, you guys will know sort of what I'm asking here. I'm asking what's called an overstatement question. So if I were to say to all of the students in the class, I say to the students, I say, give me a mark, right? Just give me the mark that you expect that you're going to get for back to 100, and whatever that mark is, I will allocate it to you. Um, I'll give it. I'll give that mark to you as your final mark. What do you think? What problem do you think I'm going to have? Right? Do you think the marks are going to be too high or too low in that situation? Type your answer out in the chat. So I've asked the students, I said, students, give me any mark that you want, and then I am going to allocate that mark to you for back to 100. And most people got it right. The marks are just going to be astronomical. Right? They're just going to be very high, right? And so um, if we just went to the entity and we said to the entity, just estimate the amount that you're going to get, and then consider that to be your revenue, we would have a problem, because all the entities are profit generating entities. They're going to just allocate the biggest amount that they can find, right? And I mean, in the morning lecture, I asked the students the same question, and a lot of them, they said, I'm going to get 110%, 120% for back to 100. So you can imagine what would happen in a company where there's actual money involved. They would overstate it. So we need to have that second step, and that second step is called the constraining step. So we start to look more realistically. What do we think is most likely? What amount do you think is most likely? Has the highest probability of that might happen, right? So what is the highest probability mark that you might get? And then if I were to ask students to do that, then I think a lot of them from their first estimate of saying, oh, I'm going to get 110%, I'm going to get 120% for, and 100% maybe for back to 100, you'll find that their marks, if I say, what is the mark that you think is most likely? And the closer you get to that mark, the less I will decrease. So if you're able to guess that mark on the dot, I'll give you 10 extra percent. But if you're off by 10%, then I'm going to minus 10% from your mark. And then you'll find that their estimations will go from about 110 down to about 50, maybe 52, 53%, because that's basically, that's no, I'm being mean now, maybe 55 to 60%, because that's basically where the bulk of students are sitting, right? The bulk of them are getting between 55 to about 65. So you'll find that their estimations will just drop right down. So in that sense, this is why we need the second step. The second step is to try and constrain that estimate, try and pull that estimate down. And we say, what is the most likely estimate that will not result in a restatement, right? And then we say, you're going to see, in fact, we don't do disclosure for this section, but in the disclosure section, if you guys have spare time, you'll see that what they make the entities do is, if they have a restatement of revenue, they make them put it in a separate note and highlight it, right? And so basically what that does is it deters entities from having these massive revenue estimations and then having massive write-downs when they realize that the estimation was incorrect. Because every time you write it down, you need to explain to the user of the financial statements why you wrote it down. So it's a big penalty. And so people are scared to overestimate. And so that's sort of how the board gets around these astronomical estimations. So someone's asked a question. So the entities derive estimates based on past revenues. So past historical data, yes, they need to look at historical data. I'll talk to you just now about some of the stuff that we need to look at when we start talking about constraining the estimate. Where is it? Is it here? Is it? I think it's actually in the next lecture that's coming up after this one. Okay, so that's sort of what we need to do. Now, I want to just talk to you about a few discounts, right? So these are discounts that you guys are going to see in your tests and exams, and I just want to basically give you the cheat sheet on it. So in terms of the discounts, first discount that I want to talk about is trade discount, right? So trade discount is a discount that you give to someone because they are trading with you, right? Because they're buying your product and not someone else's product, right? That's a trade discount, right? The purpose, the reason for why the discount is given is because the person is trading with you. So because a contract is concluded and because the customer has paid you, that means that automatically they have now earned the discount. There's no question about it. There's no variability, right? There's no variability with the trade discount. You know for a fact that they're going to get the discount because the discount is given to them because they're trading with you, right? So in that sense, because the customer is a customer, they have qualified for the discount, right? So that first discount, trade discount, is not very variable. So we'll call that a fixed discount. Okay, that's a fixed discount. We know that it's going to exist. And if we go back to our definition of a transaction price, right, it says the amount that we expect to be entitled to, or the amount that we expect to receive, right? So when we look at a trade discount, can we say that we expect the transaction price to before the trade discount or after the trade? We have to say after, right? Because we know that the customer is getting this discount the day that the customer walks into our business. So there's no question about, there's no variability about it. So we need to remove any trade discounts from the transaction price. Okay, we need to remove any, so the transaction price will always be net of trade discount. It will always be less trade discounts, okay? The transaction price, okay? Now so that's the first one. That's the a sort of fixed discount. Let's talk about the next two. Now, the next one is called a settlement discount. A settlement discount is given to a customer, and you say to the customer, if you settle your account within so many days, you can get a discount. Okay, I just want to see, someone's asked a message. I am the only one experiencing the sound problem. Can you hear? Yeah, so someone needs to answer that, because also I would like to know if you guys can hear me. Okay. Okay, so let's go back to a settlement discount, right, guys? So I was saying a settlement discount you give to the customer. So the second one, you say, if you settle your account within a few days, let's say 1 day or 2 days, if you settle your account, but it's more like 15 days or 30 days, but anyway. So if you settle your account within this time, I'm going to give you a discount because you are paying quickly, right? It helps me with my cash flow in my business, right? It helps me with my cash flow. And so you're paying, someone said, get refresh. I'm not sure about what that means. Anyway, so the settlement discount you issue. So now the question is, can the entity control when the customer pays? Can the entity control? Think about it. Can I control when? So let's say you lend money to your roommate. Can you control when they're going to pay you back? Not really. That person can sort of run away with your money, right? Um, and so you got a situation where there is an element of variability with the settlement discount. There is an element. I don't really know 100% whether this person's going to pay me or not. So that you can't be certain that the person is going to pay you on this specific date. Yes, they can say, yeah, I'll pay you, but they don't pay you, right? So you have a situation where there's variability, right, with the settlement discount. So that is a variable element. So it won't be included in the transaction price until we do the variability tests, right? So we must do these tests that we are speaking about here. We must do this whole exercise in order for it to be included in the transaction price. So a volume discount, or sometimes called a volume rebate, right? So this word is sometimes called rebate. Volume rebate, you say to the customer, if you buy 10,000 of our units this year, you will get a rebate. You'll get a money back, you'll get a discount, right? So that is what a volume rebate is. And again, with the volume rebate, there is an element of variability, right? So volume rebate and settlement discounts are variable, whereas a trade discount is not variable. And because it's not variable, it needs to be taken out of the transaction price from the very beginning. Right? We don't need to do any tests. We don't need to estimate. We don't need to constrain. It's just taken out because we know the person is getting that trade discount. Right. Okay. So those are the different types of discounts. Now, I just want to talk to you briefly about how we should account for the settlement discount. So with the settlement discount, at the beginning, at the inception of the contract, when we are satisfied the obligations, we are not sure about whether the client is going to pay on time or not. Now, this is the same reasoning that we would use for volume discount, right, or volume rebate, right? We're not sure whether the entity, whether the customer is going to buy a specific amount of volume. However, what we'll do is we look at historical cost information. We look at not historical cost, historical information about this customer, historical information about our business, and we will create a best estimate, right? And so that's where the estimation part comes in, this part here, the expected value. Right? So we're going to create an estimation based on the information that we have, all the information that we have on hand. And then when we come up with that, we can determine, is this customer going to get the discount or aren't they going to get the discount? Now, what that means is that when we record the transaction, we must remove this settlement discount and keep it in a suspense account. Right? And remember, I hate the word suspense account because everyone doesn't understand how a suspense account works. But anyway, you must keep it in this thing called a suspense account until such time that we know for sure that we have certainty as to whether they have the discount or not. And then we can decide what to do with it. Obviously, if they don't have the discount, then we need to take this settlement discount and recognize it as revenue, right? That makes sense because they didn't get the discount, so therefore it must be revenue. And in the sense that they do get the discount, we might need to use the discount amount to reduce the debtor that we have on hand, right? And the same story with the rate or the volume discount, right? So it's the same. We have the exact same slide if I was to explain both of them, right? So that's sort of how it works. Right, now, I wanted to do example 9, but I don't think we have enough time. Instead, we'll do this example because you guys don't have this example in your textbook. What goes in the suspicious? I don't know whether you were trying to be funny or not, but I like that word. I'm not going to call it suspense account anymore. I'm going to call it the suspicious account. So funny. That's a good one. The suspense account is basic. That's just, I mean, you need to make a meme out of that. That's just so funny. When accountants will find that very funny. So, the suspense account is basically an account that when you don't know what to do with an amount, and the amount is in suspense. Suspense means it's up in the air. We don't know what to do with this amount, so we put it in this thing called a suspense account, right? Which is generally an asset or liability. It's never income or expense, right? It's generally an asset or liability, and we put it in this thing called a suspense account, and we keep it there until such time that we know what to do with it. So that's all it is. It's just an account that we don't know. We have an amount of money, or we owe an amount of money, and we don't know what to do with this money. We don't know how to classify it. We don't know where to put it on the financial statements, and so we put it in this thing called a suspense account. And the idea with a suspense account is that it is always, right, and this is why I say people don't understand that it always needs to be eliminated, right, before month end, not year end, month end, month end. So basically, by the end of the month, I need to know what to do with this amount. So that's how a suspense account works. And if you do a little bit of investigation into what happened in 2001, I'm sure most of you were either very young or not even born, right? you were either a twinkle in your parents' eye, or you were extremely young, right, in 2001. But in 2001, what happened with Enron is they were misusing suspense accounts, right? Not only were they having businesses that they weren't recording on the balance sheet, but they were also doing funny things with suspense accounts. So do debits and credits apply to suspense accounts? Yes, they operate depending on what the account is. Whether if you're receiving money, you would create an asset suspense account. But if you're going to see now, I'm going to show you a suspense account just now. But when you owing money, you're going to use a liability as suspense account, and therefore it will increase on the side that assets increase or liabilities increase. Okay, so let's have a look at this example. Right, so I just want to point you to something, right? So I want you to open your textbook now to 147, and you're going to look at example 9. So this example sort of comes very loosely from example 9, right? So let's just look at this example, and then I'll show you what this lady is talking about in her textbook. So anyway, she said the example says now on 1 March 2019, Palm Limited sells goods to BG's Limited on credit for the following. The following information relating to the transaction is available. So the sales price or the transaction price. So they're not wanting us. They are very careful not to say transaction price here, like what I did, because that tells us that we don't need to do any more calculations, right? Yeah, 147. So they very carefully here put the word sales price, or they can even put the word contract price here, right? Because they want us to know that we don't know what the transaction price is. Anyway, so the sales price is 800 Rand. There's a discount of 10% if the entity settles in 20 days, right? So this is it's a settlement discount. It says so on the page. So Palm Limited makes use of control accounts for the debtors and creditors. So how would we calculate what would we calculate on the transaction date? So now let's think about it before we look at the journal entries, right? Because there's a risk that we just look at the journal entries. We need to just think about it. So we've got a variable consideration, okay? And the variable element is the settlement discount, right? We don't know what will happen in 20 days' time. So we have a variable element. And that variable element we're going to put in a type of suspense account, right? Okay. Then on the transaction date, right, we're going to recognize a debtor. So we have to create a debtor. So we know we're going to debit trade receivables or debit debtor, right? So that's the first part of the transaction. Then we know that we're going to need to recognize revenue, right? But because we've got an element that is a variable and we don't know what to do with it, right? It's in suspense, right? We're going to not recognize the full 800. We're going to recognize the 800 less that amount that we don't know what to do with, right? So that amount that we don't know what to do with will turn out to be 80 Rand, and that's because 800 times 10% is 80 Rand. And so the amount that we know is revenue is going to be 720 Rand. So we're going to have the debtor, then we're going to have revenue, and then we're going to have the suspense account called allowance for settlement discount. Now, and what you're going to see, right? So if you turn over the page on page 148, right? There's a discussion at the top of the page, and I want you to highlight that and read it in your own time. There's a discussion at the top of the page where the author makes an argument for what's called a negative asset, right? She says that this suspense account is what we're going to call a negative asset. So it's a negative asset. It acts like a liability, but it actually is related to the asset, because when we display the trade receivables on the face of the balance sheet, we are not allowed to display it without also displaying the settlement discount, right? Without also netting off, because what the entity really expects is that we're not going to receive this money. So it's what they call a negative asset, right? Okay. I'm scared that I'm going to lose you if I talk anymore. Let me just move on to the first journal entry. So the first journal entry says the person pays in 16 days, and therefore, because we ask them to pay in 20 days, if they paid in 16 days, they get the discount, right? They get the discount, right? The discussion is on page 148 at the top of the page. You'll see it starts off with variable discount. It's that paragraph with the 2 bullet points. That's a very important discussion that I want you to read through and highlight and work through and understand, right? So that's important. What was I saying? So I was saying in the first scenario that we have, the entity pays early and gets the discount, right? What would we do then? Because they paid early, we're not allowed to take any of the revenue related to the discount, right? They are only going to pay the amount net of the discount, the amount less the discount. So they'll only pay 720, okay? That's the only amount that we're entitled to. And the 80 needs to be eliminated against the debtor that we raised. Because remember, we raised the debtor at the full amount. Now let's have a look at the journal entries. So, like we said, if you have a look at the journal entries, the first journal entry is the debtor's journal entry. So this is supposed to be debtor's control or trade receivables, right? So we raised that for the full amount of the contract. We raised it for the full amount. But this 80, we don't know what to do with it. So we put it in this negative asset, right? We call it a negative asset account, right? It's a suspense account, right? We put it in there until such time that we do know what to do with it, okay? And what the amounts that we are certain about, the revenue that we are certain about, we put into revenue. Okay, so that first transaction is easy, right? The first transaction is going to be fine, right? Now when the person pays, they're only going to pay the 720, so the amount less the discount, right? So that's what we're seeing there, and we're gonna net that off against the debtor that we got on our books. But then after we net that 720 off, we are not entitled to any more money from the debtor. Does that make sense? The debtor's paid their account. They've paid their account and they've gotten a discount, so we're not entitled to any more money from them, right? But we've got a problem because we raised the debtor for 800 rand and we've only got paid 720. So in the debtor's account, there's an amount of 80 rand still sitting there. Okay, the amount of 80 rand is equal, obviously, to the discount, right? And so what we do is we net this negative asset off against the debtor. We net the two amounts off. We eliminate the two amounts, right? I also don't like that word net, right? So we eliminate the two amounts, meaning that the discount now disappears as well as the debtor. And so we would have only recognized revenue for an amount of 720 in this situation. Okay. I'll take questions just now, so start typing them if you have any. Then with the second scenario, the person pays late, so they don't pay within the 20 days, and therefore they don't get the discount. So what do we do there? So the first journal entry is the same, right? The first journal entry hasn't changed. The one at the inception of the contract. So that one's the same. We understand this one. We're going to put a big tick there because we know what this one is all about, right? So we're not too focused on that one. Now let's look at the second journal entry. The person pays, but they pay the full amount. They pay 800 because they didn't get the discount, therefore they have to pay the 800. We then eliminate the entire debtor. So we eliminate the whole 800, right, which is equal to that. But now we're left with a negative asset, right? We're left with a negative asset for the settlement discount, negative asset of 80 rand, right? This amount has been obtained. We have received it in relation to and in exchange for the goods that we've given the customer. Right? It's within this 800 rand, this 80 rand. It's within that 800 rand. Therefore, because we've received it in the ordinary course of business, remember what's the definition for revenue? It's an ordinary course of business, consideration received in exchange for goods and services in the ordinary course of business. And because that is the case, we now need to move this 80 rand into revenue. So in this situation, after everything is said and done, our revenue is now 800 rand. Whereas in the previous one, it was only 720. Okay. Now, guys, we are a bit behind. So what I'm going to do is I'm going to take a break now and take all questions. And then when we return, we'll finish up lesson 3, and then we'll go on to lesson 4. Let's just take 5 minutes. I know it's a little bit less than what we used to, but we'll take 5 minutes and I'll see you guys back at 1:35. In the meantime, if you have any questions, then I'm just going to stick around here and answer your questions. Yes, that's correct. A negative asset acts in the opposite way as a normal asset. It'll increase on the debit side, and I mean, it'll increase on the credit side and decrease on the debit side. However, it does not get shown under liabilities. It has to be shown together with the asset. So when you see the asset amount, when you see trade receivables on your balance sheet, this amount of the discount has already been removed. It's already out, right? It has to be shown net. The trade receivables is shown net of the discount. Okay, so that's why we call it a negative asset, because it can't go anywhere without the asset. It has to go hand in hand with the asset. It's married basically to the asset. All right. Someone else has asked, does crediting more? Not sure what this means. Does crediting the debtor more of like increase creditor's control? I think what you're asking is, you're saying, if we have a debtor of 1,000 rand and we somehow credit them for 1,100 rand, does that make them a creditor? And the answer is yes, that does make them a creditor. People that are doing internal auditing, when you guys are article clerks, one of the tests that auditors perform is to look at the debtors balance and identify creditors, and to look at the creditors balance and identify debtors. I hope that's the question you're asking. If it wasn't, then please just rephrase it and send it. So the next person asks, should you always consider that the customer would pay within the settlement date when writing the journals? And the answer is no. What you need to do is you need to look at the historical information. So we go back to sort of this slide. We go back to this slide. So we need to look at the historical information. We need to look at what is the highest probability. We need to basically create an estimate and then constrain that estimate. Now, in the question that we did here, we didn't need to do that because, number one, it's an example. And number two, in your tests and exams, I will tell you the entity expects that the customer gets will take advantage of the discount. Or I will tell you the entity expects that the customer is going to take advantage of the discount. And then a few sentences later, I'm going to say, oh, unfortunately, the customer was not able to take advantage of the discount. And then you're going to need to pass journals like what we did in 2.B. So you're going to need to pass these types of journals if that happens. Yeah. Okay. So basically, Diego, to answer the question more directly, in the real world, you should be doing all of that stuff, like going and estimating the amount and constraining the amount and looking at historical data and doing all of that bits and bobs. But for your tests and exams, I'm going to do the work for you, and you just need to pass the journal entries. So that's basically that. So someone else has asked, so the allowance for settlement discount is a suspense account and not a liability account. Yeah, it's a suspense account. The author in the textbook has made a very good argument that we should consider it a negative asset, or basically an asset that operates and acts like a liability. That's what the author makes, and I think it's a good argument. I think it's a very nice argument. So that's why I directed you to it. So yes, the suspense account is an asset and not a liability. So we can't say the suspense account is a suspense account and leave it at that, right? Because remember, the word suspense account is not one of the elements. You know, the 5 elements. What are the 5 elements? The 5 elements are income, expense, equity, asset, liability. Everything in accounting is one of these 5 elements. And even a suspense account needs to fall into one of these 5 elements. So yeah, suspense account in this situation is a negative asset, which means it's an asset, but it works and acts like a liability. And it does that in order to decrease the asset. So the purpose of this negative asset is to always keep the real asset, being the debtor, at the correct amount, at the real amount. Does that make sense? Does that help? Wait, I'm very confused. I'm highly confused. Someone has said that the debtor is now a creditor, has been credited with 18 and under the journal 2A. And my mind doesn't really understand why we're increasing creditors. This is not a creditor. This is a debtor. So this person is a debtor. I thought you were asking if we credit the debtor for an amount that's too high, does it become a creditor? So here we debited the debtor with 800 Rand, right? Then someone paid 720. So we credited here we credited the debtor with 720, means we decreased the debtor with 720. So we take 800 times 720, we left with 80. So there's an amount, an asset, a debit amount in the trade receivables of 80 Rand. Now we need to get rid of that 80 Rand because we're not going to get that money from the customer. The customer doesn't owe us this money. So therefore, we net it off against the negative liability, or we eliminate it against the negative liability. Yeah. So it's not a creditor. It is a debtor. See, we are selling. So in the question, you'll see here that we sold the goods. So Palm Limited sold the goods, and we are doing the accounts for Palm Limited to pass the journal for Palm Limited. So we are Palm Limited. That's who we are. Okay. We are a little bit behind. Let us start. Okay, so we've already spoken a little bit about a refund liability. I just want to solidify that discussion for us, and so that we fully understand what's going on. Let me just double check that that page number is right. Yeah, it is right. 154. It is the correct page number. So I just want to solidify this discussion. So basically, a refund liability is an amount that we have received, so cash, so consideration, so money value that we have received from a customer. However, we've received it and we don't believe that we need to recognize it as revenue. Right? We've received it, but we don't believe we need to recognize it as revenue. And as a result, we create a liability, right? We create this liability to say that we possibly in the future may need to refund this person, right? So we create what's called a refund liability. Okay, does that make sense? So it's money that we've received, it's a consideration that we've received that we are not ready to recognize as revenue. There could be many reasons why we're not ready, right? Number one, it didn't pass the criteria in step two. Maybe it didn't pass the criteria, in step one. Maybe we don't have a contract. All of these reasons can come up. But the conclusion of the matter is that we're not ready to recognize it as revenue yet. So instead of recognizing it as revenue, we will include it in a refund liability, which is a liability account, right? And we will wait to see if the criteria are met, then we'll move it into revenue. If the criteria are not met, then we may need to, in the future, actually pay it back to this person, right? And we did an example, I think, in the first lecture or so, right? But now I want to talk about another situation, right? And this situation is when we sell goods, okay? And we tell someone, and you must have seen this in the Verimark adverts, on TV, right? they say, oh, we'll sell you these goods, but you can send it back. What? Money back guarantee, no questions asked. Right? That's the statement that they always say. No questions asked. Money back guarantee. Right? Has anyone heard that before? Right? So no questions asked, money back guarantee. That's what they say on the very mark. You can send the goods back. We'll take it back within 30 days. We won't ask you any questions, and we'll give you back your money. Right. So that is a situation where we might need a refund liability, because when Verimark, so from Verimark's perspective, right, Verimark is selling you these goods, right? They're selling you these pots and pans or whatever. I don't know what they're selling these days, but when I was small, they were always selling the pots and pans, right? So they were selling the pots and pans, and they said to themselves, if we sell this, there's a likelihood, there's a possibility that some housewife somewhere is buying these pots and pans without her husband knowing. When her husband finds out, he's going to say, go and return the pans, right? Go and return the pots. And so she's going to come back to us within 30 days and ask for her money back, right? So we cannot recognize that amount as revenue because technically we haven't satisfied it. Within that 30-day period, we haven't satisfied it. After the 30 days, yes, we can recognize it as revenue because then she can't come and ask for her money back, right? So after the 30 days, we can move it out of refund liability into revenue. But within those 30 days, between the time she purchased it and between the time of 30 days, it's considered to be a refund liability. Okay, so that's the first topic that I want to talk about. The next thing I want to talk about with refund liability is not only are we required to give the person their money back, the person is also required to give us what back? The pots and pans, right? So we have a right to receive something, right? We have a right to receive the pots and pans, right? And so what we need to then do is we need to recognize a right to recover or a right to return asset, right? Your textbook calls it a right to return, and you'll see that in my slide I call it a right to recover asset, right? So we now need to recognize this right to recover asset, because when we give her money, she must give us the pots and pans, right? So we have that right to that pots and pans. Okay, so we need to recognize both the refund liability and the right to return asset. So now let's have a look at that in an example. Okay, so it says we've got a situation, Retail Corp sells 200 laptops for 200 Rand each, right? Which means the total contract price, the total transaction price, contract price. The total contract price would be 40,000 Rands, okay? The production cost, right, or the cost of sales for each laptop is 100 Rand, okay? Under the sales contract, the customer is allowed to return undamaged laptops within 30 days. So this is the same thing we're talking about, the Verimark situation, right? Money back guarantee. No questions asked. That's what they always say, right? So, so that's what it is. Now they say based on historical information, right? So this is what someone was asked. I think it was Diego or was it Carlo? Someone was asking me, do we always, how do we come up with this situation? This is what you're going to see in your tests and exams, right? We're going to say something like this. Based on historical information, the return rate and current estimates at Retail Corp, we estimate that 10 laptops will be returned. So that's what you're going to see in your questions. We're going to do all the work. We're going to do the estimate and then constrain the estimate, and you're just going to get the number 10 laptops will be returned. Furthermore, it concludes that costs of recovering the laptops are not, so the cost to recover the laptop, meaning the transport costs and that sort of stuff, is not going to be significant, right? And the laptop will be resold for a profit. Okay? Now, let's have a look at the journal entries that we're going to pass. So these are what the journal entries look like. So we've received the money from the housewife, There's the money coming in here at 40,000, right? Now, we know that 10 laptops will be returned based on our estimation, right? So we estimate that 10 laptops will be returned. So we're going to say 200, right? 200 Rand times those 10 laptops, right, is going to be our refund liability. So that refund liability, we're not going to recognize it as revenue. We're going to recognize it as a liability on the balance sheet. Okay, the rest of the revenue is fine. We don't expect that we're going to have to pay that money back, so we can recognize that revenue immediately on day one. Right? Then let's talk about the asset. Because that person is returning their goods, we have a right, right? We have a right to collect the goods from them. So we have a right to recover asset. Your textbook, as I said, calls it a right to return asset. Right. And the right to return asset is calculated at the cost price. Why is it not calculated at any other price? Why is it calculated at the cost price? That's because the value of this laptop to us is worth 100 Rand. The value of the laptop when we sell it is 200. We put a markup on it, is 200 Rand. Right? So when it comes back into our entity, back into our company, we need to now recognize it at that value that it is to us at the 100 Rand amount. We can't recognize it at the 200 Rand amount, because that 200 Rand amount is the value that we're charging other people. It's not how much it's worth to us. Okay. So anyway, we can't. And what's the idea behind this, right? So we have inventory that we have sold, right? We put 1,000 Rand or 10 laptops into right to recover asset, right? And the rest of the laptops, so the 190 laptops, we put in cost of sales. Now, the idea behind this is we want the revenue, right? We want the revenue as well as the cost of sales to relate to the same amount of units, the same amount of goods. So in both cases here, they relate to, or they are representing 190. Does that make sense? Does everybody understand that they both? Why is that important? Because these two people here are going to get together, right? The revenue and the cost of sales. And what's going to happen? They're going to have a baby called gross profit. Okay, and if one is too big and one is too small, they're not going to have, the baby is not going to be right. Okay, so the gross profit is not going to be right. So you have to have them representing the same amount in order for the gross profit to be correct. Does that make sense? Everyone on the same page? Everyone seems very quiet now. Okay, there we go. Now, the final sort of topic that we want to talk about in lecture 3 is this idea of a non-cash consideration, right? So in terms of page number, let me just double check the page number. Yeah, it's correct. So 165. In terms of a non-cash consideration, when we receive value from our customers, right? But it's not in the form of cash. It's not in the form of money. It can be in the form of an asset. It can be in the form of some other types of shares. It can be in the form of something, but not money, right? We need to record the revenue at the fair value of that thing that we've received, right? We need to record the revenue at the fair value of the thing that we've received. In some cases, you're going to find that we can't find the fair value, right? And in those very specific cases, then we're going to use the stand-alone selling price, right? So the amount that this item would be sold for, and that's going to represent the revenue. Okay, that's going to represent the revenue. Okay. The one important concept that I want to explain about this part of the lecture is control. right? The word control. So when you're looking at a non-cash consideration, the question that you have to ask yourself is, will our entity control this asset? Right. Now, let me give you an example. Um, uh, you have a domestic helper, right, that comes to your house and cleans the house. Okay. She'll come to the house, she will use your broom, she will use your bucket, she will use your mop, she'll clean the house. But then when she leaves at the end of the day, she doesn't take the broom, she doesn't take the bucket, she doesn't take the mop. Those things remain in the house. Okay? As a result, because she hasn't taken control of those things, because it doesn't, it's not hers to take home, you see, those items are not hers to take home. Because of that, she cannot consider those items as non-cash consideration. She cannot take that into account as payment, is what I'm saying. She can't say, oh, because I'm using this broom, I must consider that broom to be my payment, my salary. Right? It's not her salary. Does that make sense? And the reason why it's not her salary or not her wage is because she hasn't taken control of the item. So, in the same sense, when you're looking at a non cash consideration, the question you need to ask yourself is, are we taking control of these items? Are we owning these items? Right? After the contract has been concluded, do we still own the item? Or do we just have a right to use the item? Do we just have a right to use the item, or are we taking control of it? Okay. Now, there's a good example 23 in your textbook. There are also stuff that I've put down as tutorials. So we're not going to have a specific example on non-cash items, but it is a very important topic, and it is quite a nice topic to test, because then you see whether the student um, um, okay, so non-cash item, again, we recognize non-cash items at the fair value, and if we can't find the fair value, we use the standalone selling price. The key with non-cash items is that we must take control. Okay, that's it in a nutshell. Okay, so now we want to start to talk about step four. So again, in step four, so in step three, we found out what the transaction price is. In step four, we are now going to allocate that transaction price to the different obligations so that we can start to recognize revenue. Okay. So, and remember, the key principle is that we want to always record the economic substance of a transaction over its legal form, meaning that we want to record what we expect, right, to get the money that we expect to receive from this specific contract. Okay, so that's what we're doing in step four. Now, step four, you're going to see when we talk about it on Thursday. But the key principle in step four, the key principle, is that we must allocate the transaction price as much as possible on relative standalone prices. That's the key principle. There's a chair, relative standalone prices. So what's a standalone price? What is a standalone price? A standalone price is a price at which the entity sells the specific performance obligation when it is sold separately. So just explain that in more detail. So we have a situation where, let's say, we sell a mouse and we sell a keyboard, right? But when we sell the mouse individually, what is the price? And what is the price when we sell the keyboard individually? Those individual prices are going to be considered the standalone prices, right? So when we sell them as a bundle, right? So now we're only going to be dealing with sort of bundled goods. When we sell the mouse and the keyboard as a bundle together, right? Then we need to look back at the standalone prices in order to allocate the revenue. Okay, that's basically what we're saying. And so in today, so that's the principle, that's the key principle, that's what we need to do. This test of finding the standalone prices, the test is only done at the inception of the contract, right? So again, this is another test that we only do once. We only do it at the inception of the contract. Okay. So that's that's the key principle, is the standalone price. Now, so what do you do when you get your question in your test and exam? These are the steps you need to follow. The first thing you need to do is you need to find out the standalone prices for each. So let me highlight that word, each of the POs, right? For each of the POs, we need to find the standalone price, right? Hopefully, we can use what we call the observable price, right? But sometimes we can't. But hopefully, we can use the observable price. Okay. And then we need to calculate what is the total standalone prices for all of the POs together, right? And then finally, we allocate the transaction price in the ratio of standalone prices to total standalone prices. We're going to do an example. We're actually going to do 3 examples just now. So I'm not going to spend any more time on this slide, but we will come back to it just now, just to refresh our memories. What's a PO? Who can answer what's a PO? Pop your answer in the chat. Okay. While you guys are busy answering Benjamin, I'm going to continue here. So the standalone price, okay, the standalone price is, yeah, so people are saying performance obligation. That's correct. Okay, so remember step 2 where we did performance obligation, that's a PO. Okay, so the price, so how do we determine the standalone price? Now, when determining the standalone price, generally we need to use observable data, meaning we need to go out to the market and find what the amount is in the market, right? So that is the first thing that we need to do. We need to find the observable price out in the market. Now, that might involve us, looking around maybe at the competitors. It might be looking at our own company, but we must use the best evidence that we have to find the observable price, right? The observable price that makes us think that we need to look at some sort of market, right? So then the question then is, what happens when we don't have an observable market, right? What happens when we don't know what the price is? Now, the standard gives us some tips about things that we need to keep in mind. The first thing that we need to keep in mind is that we must always use all available data, right? We must always use all available data in estimating the standalone price, right? We're going to talk about how we're going to do that just now. So we must use all available data. Then, right, we must always be consistent with similar contracts or the same client. We must always be consistent in how we estimate the standalone price, right? Always be consistent, right? Then, if all else fails, right, and if we still can't find the standalone price, then we must consider using the cost plus model, right, where we take the cost and we add a markup, the cost plus model. And even if that fails, then we can use what we call the residual technique, which I'll explain to you just now, right, how the residual technique works. The residual technique just basically works only in a situation where every other performance obligation, every other PO has a standalone price and one doesn't, right? And that's when we can use the residual technique. That's the only time when it works. Okay. So just to summarize again, so this is a summary of the previous slide. It says when we're looking for the standalone price, we must try and use the observable data and use the best evidence. Now, if that fails, then we must try and estimate the price. We can estimate it by looking at the market and maybe adjusting for something. We can estimate it, and that's where we need to sort of use all available data and whatnot. Then we can estimate it by doing the cost plus model, and then we can estimate it by doing the residual model, right? Now, I just want to look a little bit at these models in a bit more detail. I'm cognizant of the time. We are moving quite slowly for some reason today. So anyway, so the market adjusted approach is where we look at a competitor's price or the price, the general price in the market, and we adjust it for specific things that are happening in our entity and specific things that are happening in our contract, right? So we need to adjust it for any sort of specific particulars that are happening in our entity or our contract. So that's what the market adjusted approach is, right? The next approach that we can look at is the cost plus approach. Now, I don't feel I need to explain this, but anyway, I will. A cost plus approach is where we take the costs of a PO, of a performance obligation. We take the costs that we are going to incur to create this good or service, right? And we then add an appropriate markup. Now, the standard doesn't tell us what appropriate means. It just says appropriate or reasonable markup. And so I think a lot of what's the word? A lot of professional judgment comes into determining what an appropriate markup is. So it takes the cost, we add this appropriate markup, and that it will give us our standalone price. And then the final one is where everything else has a standalone price. So this is the residual method. Everything else has a standalone price, but one PO does not. And then what we will do is we will take the transaction price minus all the other standalone prices that we can determine, and whatever we're left with, whatever the residual is going to be the standalone price for that last PO. So that's what it means, right? Now let's do an example. So we're going to start off with an easy example, and then we're going to go to hard examples, right? So this is an easy example, right? So Volkswagen at Mponya Mall sells a Polo, right? 1.4 to SK, and included in this contract is a maintenance plan for 2 years, right? So they sell the Polo and the maintenance plan. They give them a very good deal, and he only pays 250,000 for the car and the maintenance plan. However, when we look at the standalone price, we see that the standalone price for the vehicle is 220,000, and the standalone price for the maintenance plan is 50,000. So if you add that up together, how much is that going to give us? That's going to give us 270. So it's above the transaction price, right? The two standalone prices are above. How do we allocate this transaction price? And the answer is we do it in the ratio of the standalone prices. That's what we said. The theme of this section, the theme of this step at least, is that we allocate the transaction price. Can everyone hear me? Okay, it seems like some people can hear me, but sort of on my screen, I got disconnected for some reason. Anyway, so we were saying we allocate the transaction price. Now, in this question, the transaction price is 250, right? The standalone price is 220 and 220 and 50. So let's go back to our steps now. So we go back to our steps. We say we need to determine the standalone price for each PO. Have we done that? Yes. We've determined the 220 and the 50. Right, back to our list of things that we need to do. Back to our list of things that that we need to do. Right, so we need to now calculate the total for all of the POs. So we calculated the total, it came to 270, and then we need to allocate the transaction price by the ratio of the POs of the standalone prices to the total standalone prices. Let's have a look at what that looks like. This is what we do. So we say the vehicle was 220, the maintenance plan was 50, right? So that gives us a total of 270. The ratio, therefore, of the vehicle to the total standalone price is 220 over 270 multiplied by the transaction price of 250. That means that the revenue we need to recognize is 203,704 Rand. Okay, does that make sense? We'll do the same thing for the maintenance plan. We'll say the standalone price of the maintenance plan is 50. The total standalone price is 270. We multiply that by the transaction price of 250, and that gives us the revenue we need to recognize of 46,296 Rand. Okay. So we add those 2 amounts up, and that should get us back to the transaction price of 250. Right, now just, I know that this is step 5, but I just want you to keep in mind that in step 5, we're going to start talking about the fact that the business or the vehicle the ownership passes instantly to the customer when the customer drives away with the car. So that we'll recognize that revenue when the maintenance plan, we have to recognize it over a 5-year period, right? But I told you just refer to step 5 because we haven't gotten to that yet. Okay. Does everybody understand? Any questions so far? Okay. I think someone has said that you guys understand, but yeah. So if you don't understand, then please just, you need to say something. Remember, I told you in class about drowning quietly. You must never drown quietly. Okay. So that's the first example. Let's look at the next example. So in the next example, we have Hustle Limited. Hustle Pty Limited. So Hustle enters into a contract with someone to sell. I'm not going to pronounce that name because I'm going to embarrass myself. So they sell 3 products, product A, product B, product C, and the total contract price is going to be 250. Okay. Now it usually sells C for 120. Right? It usually sells C for 120. And it is the first time that Hustle is selling product A and B. So they've never sold product A and B before. However, they know that the cost that they bought product A and B for was 120 for product A and 20,000 for product B. So they have the cost, right? They say in general for product A, they would like to apply a markup of 10%. And for product B, they would like to apply a markup of 20%. Now, the question is, how would we split, right? How are we going to split this transaction price of 250? How are we going to split it, right? So let's have a look at what we do. Now, here we're going to use the cost plus method. This is the cost plus method, right? And so let's see what they did. All right, so here they took the cost of 120 and 20. They've applied the markups that we were given in the question to come at the transaction, the standalone price of 132 and 24. 132 and 24. Does everybody understand how we got those numbers, right? So this is now our new standalone price. So because we couldn't identify it in the normal way by looking at the market, we have to now use the cost plus method to come to the price. And so now this is our new cost plus method. This is our new standalone price of 132 and 24,000, right? So then after that, we just treat it normally like how we did the last one. We add all of them up to get to the total standalone price of 276, right? We then, so you're going to see here in this last column, we then take the individual standalone prices of, let's say, 132,000. We then divide it by the total standalone prices of 276,000, and we multiply that ratio that we get, we multiply it by the transaction price. And that will tell us how much we need to allocate, how much revenue we need to allocate out of this transaction price. Okay. And so we do that again, obviously, for product B, and then finally for product C. Okay, so that is the cost plus method, right? So it's not too hard, right? So let's have a look at another way of doing it. This is the sort of the is it example 3? Yeah. So we say Hustle Limited entered into a contract again with the same dude, right? And for product A, B, and C. Okay, the total value of the contract was 250,000. Okay, total value of the contract is 250,000. Hustle normally sells product C for 120. B will be sold for the first time by Hustle. Right? Hustle bought B for 20,000 Rand, and Hustle intends to have a 20% markup. Now that's exactly the same to sort of what we did in the last example, right? And then it says, but product A, again, Hustle hasn't sold product A, but Hustle knows that product A can sell for between 100 and maybe 120. So there's no definite amount. There's no definite amount. Now, what is this pushing us to use? It's pushing us to use one thing. The only thing that we can use is the residual method, right? Because remember we said in the residual method, you'll be able to calculate the standalone prices for everything else except one PO. And here we're able to calculate the standalone price for everything else except product A, right? So let's have a look at what this looks like. Right. So we say, okay, so product C, so I've actually changed the order now. So I'll say I've gone from the easiest one. Product C, really easy. We've sold it before. This is the price. It's 120, right? We're happy with that one. Product B, we'll use the cost plus method where we take the cost, increase it by the markup of 20%, and that's going to give us 24,000. Now, whatever is left then gets allocated to product A. Whatever is left then gets allocated to product A. And when we add all of these up, we're then going to come to the transaction price. So this is the format in which we allocate, you see? This is the way in which we allocate this into revenue, okay? Right. Can you see how each of the methods that we used produced a slightly different answer? Number one. Number two, each of the methods that we used resulted in us having to receive from the examiner, from the lecturer, we received different information. Okay, so just based on the information that we received, we can tell what method does the examiner want us to use. Does that make sense? we wouldn't allocate it here. In fact, we do allocate it, right? We allocate it based on the residual method. And the residual method says that the ones where we can definitely identify the standalone selling prices, we just allocate the revenue based on that, equal to that standalone selling price. Right? So here, the standalone selling price was 120. Here, the calculated standalone selling price was 24. So we allocated revenue equal to that, right? And whatever is left over, we do. I think the question you ask is, do we use any ratios here? And the answer is no, we don't use any ratios, and we're not doing an apportionment method here. But we are recognizing revenue is what I'm trying to say. I'm saying we're still recognizing revenue. It's not like we're not recognizing revenue. Will they tell us which method to use? No. You need to identify which method to use by the information that you're given. Right? So you need to go and identify. So if you have a look, each set of information is slightly different. So for example, this is the residual method. You can see that one PO we haven't given, we just said it's between here and here. We don't know what price it is. The next one, we've given you the cost, right? The previous one. We gave you the cost, right? We gave you the cost and we gave you the markup. So you knew sort of what to use. So you need to use the method based on the information you get. But you also need to remember that if you use the wrong method, you will never be able to get to a final answer, right? Because, for example, if let's say I go to this, this sort of question here, and I want to use the residual method, but then no, not this question, the one before. If I want to use the residual method here, it wouldn't work because I've got the cost. So I have to use cost plus markup for both, right? It doesn't make sense for you to use residual there. Okay. Anyway, so the sort of last thing that we need to discuss is, for today, is the allocation of the discount. So far we were discussing the allocation of the transaction price. The allocation of the discount needs to be done. So this is a key principle here. We need to do it in the same way in which we allocated the transaction price. The same method that we use to allocate the transaction price is the method that we must use to allocate the discount. Remember, we spoke about that consistency. Whatever we use, it must be consistent. And so we need to allocate the discount in the same way that we've allocated the transaction price. Now, when allocating the transaction price, we said the method that has to be used is we need to allocate it based on the standalone selling prices. So for the majority, the vast majority, in fact, of our questions, you're going to see that we're going to allocate the discount based on the standalone selling prices, right? So the vast majority are going to be that one, right? Especially in BAC 200, we sort of only will use the standalone selling prices for now. We're not going to do anything funny, but just for your information, there are sorts of other things that we need to take into consideration, right? Sometimes in a contract, we will be told that not all the POs in the contract are allowed to get a discount, and only one specific item amongst the POs must be discounted, right? And obviously, in that case, we need to basically apply what we are being told from the contract, as long as the specific PO that we're dealing with, or the specific PO that's attracting the abnormally high discount, is distinct, right? And in the contract, it mentions that this is the only PO that is getting the discount, right? So those are sort of the criteria that we need to look at. Okay. Okay, cool. So we've got an example here to allocate the discount, right? We also got an example in the textbook that you can go through. So example 27 to allocate the discount. I just want to quickly go through this example, and then we can end the lecture, right? So let me just read it quickly. So entity B enters into a contract with the customer to sell a television, speakers, and an entertainment unit. The total price for all three of these things is 210. I mean, 2,100. So the television and speakers are always delivered at the same time. On a regular basis, the entity sells the television for 1,700. It sells the speakers for 300 and the entertainment unit for 300 also. So then it says, in addition, so I'm reading point 4, in addition, entity B regularly sells, so this is the important bit, entity B regularly sells the television and the speakers as a bundle, right? So what have they done here? They have bundled the two goods together. We have two goods that are not distinct. And why aren't they distinct? Because they generally always are sold um, together. They are sold together in terms of this contract. And so we've got now, from having 3 POs, we're now down to 2 POs. And the 2 POs is the television and the speakers, and then the last one is the entertainment unit, right? And so anyway, it says the customer purchases all three for 2,100, but the customer receives a discount of 200 rand for purchasing it as a bundle. Now, in terms of the transaction price, how would we allocate the transaction price? Well, we can see that the entity, from a standalone perspective, right? The entity sells these goods regularly as a bundle, right? Sells the television and the speakers regularly as a bundle. So we can allocate, and it's also delivered at the same time, all of that stuff, right? So we can allocate the television and the speakers out of the transaction price. We allocate them 1,800 because they're regularly sold at the price of 1,800. Okay, and that's their standalone selling price for that PO. The entertainment unit is regularly sold for 300 rand. So that would be the standalone selling price for that unit. When we add the two amounts up, we find that we come back to the total of 2,100. So there isn't really any need to allocate that. When we add the 1,800 plus the 300, we come to an amount of 2,100. So there isn't really any need to allocate the transaction price. However, we need to now allocate the discount. We need to allocate the discount in the same proportion that we've allocated the transaction price. So my question to you is, what is the amount of discount that we would allocate to the that's the total, but what is the amount of discount that we would allocate to the television and speakers, right? So you're going to get a number that I want you to type into the chat. What is, so guys, for this one, the answer is not on the slides. You have to type it out in the chat. So what is the amount that the entity will allocate in terms of the discount? What is the amount of discount that they will allocate to the television and speakers? What is the amount? You're going to get a strange number, and I did that deliberately because I know as soon as students calculate a number and it's not round, then they get worried. So what is the amount? No one seems to be wanting to volunteer an answer here. What happened? Is everyone stuck? What is the amount? Oh, there we go. Someone has gotten the answer correct already. I'm still busy typing my answer out in the chat. Okay. So the amount that we would allocate to the television and speakers is going to be amount of 171 rand 42 cents of the discount. So they will attract, or it could actually be 43 cents. Sorry, I could have not rounded it up. In fact, I didn't round it up correctly. So it's 171.43, right? And next to that is how I calculated that amount, how I came to that amount. And then, yeah, so then obviously the remainder of the discount will be allocated to the entertainment unit, and the remainder of the discount will be 28 Rand 57, and that amount will be allocated to the entertainment unit. Okay. So we've allocated this discount in the same proportion that we allocated the transaction price. That's the key. That's the understanding that we need to leave this lecture with. Okay. Just going to type this out in the chat. Oh, shucks. I need to just amend that. Okay. That's the correct calculation. I put an extra 1 there. Okay, guys. So what you need to do for me now is I need you to read section 9. So section 9 is the next section on. Very important to read section 9. It's basically the last step. So now we're on step 5. You're going to read section 9 for me. Yes, the 28 Rand is for the entertainment unit. All right, it's just the remainder of the discount that's left in the 200. So you're going to read section 9 for me. Now, there is an important thing. Now, see, people are already leaving, but they're not going to hear this anyway. Not my problem. Let me stop the recording.